In this video, we're going to see how to calculate the fixed overhead variances. So specifically the fixed overhead budget variance and the fixed overhead volume variance. So why are we doing these separately? So remember for materials, direct labor, and variable overhead, all of those are variable costs. Fixed overhead, however, is a fixed cost. So we can't apply those same calculations, so it has its own formulas. So the budget variance, that's when we compare the actual fixed overhead to the budgeted fixed overhead. So any difference between the actual fixed overhead and the budgeted fixed overhead is what we will call a budget variance. So you simply define this variance, we'll take the actual minus the budgeted. The other variance is the volume variance. That's where we compare the budgeted fixed overhead to the fixed overhead applied. Now there's one difference with the standard cost system when it comes to the application of overhead. So if a company is employing a standard cost system, as they apply overhead to jobs or to products, they, instead of doing the POR times the actual level of activity, we expand on that and say when we apply overhead, we'll take the POR times the standard hours allowed for that actual level of activity or that actual output. So to find the fixed overhead applied to production, we'll have to find just the fixed portion of the POR first, and then multiply that by the standard hours allowed for the actual output. So the fixed POR is just the fixed portion of the regular predetermined overhead rate. So we're going to be doing this problem here to the right as an example. So we have Primera Corporation has a standard cost system in which it applies overhead to products based on the standard direct labor hours allowed for the actual output for the period. Data concerning the most recent year appear below. So we have total budgeted fixed overhead costs of $250 for the year, actual fixed overhead of $254, budgeted direct labor hours of $25,000, actual direct labor hours of $27,000, and then the standard direct labor hours allowed for the actual output of $26,000. Now, the budgeted direct labor hours you determine before the period. The actual hours you won't know until after the period is done, as well as the standard direct labor hours allowed for the actual output. Both of those you won't know until the period is over with. So let's first find the budget variance. So actually, let's do the fixed POR first. So we're going to compute the fixed POR first, and then we can worry about those two variances. So the fixed POR, we find it just like we would a regular POR, but we're just focusing on the fixed portion. So remember, your POR is going to be your estimated overhead divided by your estimated activity. But if we're finding a fixed POR, it's going to be your estimated fixed overhead divided by our estimated activity. So what is our estimated fixed overhead? Well, that's the budgeted fixed overhead for the year of $250,000. So we're going to take that $250,000 and divide it by the budgeted or estimated direct labor hours for the year of $25,000. So that gives us a fixed POR of $10 per direct labor hour. So we'll set that aside. So the first variance we'll find is the budget variance. So your budget variance is really the easier one of the two to calculate. It's just your actual fixed overhead minus the budgeted fixed overhead. So what's our actual fixed overhead here? Well, they tell us it's $254,000. So we're going to compare that to the budgeted fixed overhead, which is $250,000. So here there's a difference of $4,000. And we're going to label this as unfavorable because anytime your actual costs are more than the budgeted costs, that is unfavorable. So we spent more on fixed overhead than what we budgeted for. So that's a $4,000 unfavorable fixed overhead budget variance. Now the volume variance is a little bit different. So the volume variance is where we compare the budgeted fixed overhead to the fixed overhead applied to work in process. So we know what the budgeted fixed overhead is, right? That's the $250, or in other words, it would have been that fixed POR of 10 times the budgeted hours of 25, but it's the $250. We're going to compare that to the fixed overhead applied, and how do we find that? Well, we start with the fixed POR, and we're going to multiply that by not by the actual direct labor hours, but by the standard hours allowed for the actual output. So we should have used 26,000 direct labor hours. So we're going to multiply the 26 by the $10 per direct labor hour there, and our fixed overhead applied is $260,000 here versus the budgeted of $250,000. So there's a difference of $10,000 here. And it's going to be labeled as favorable because anytime the amount applied is more than what you budget for, you will label that as a favorable volume variance. But if the budgeted is higher than the amount applied, it will be an unfavorable volume variance. Another way to look at this is when you look at the hours that each of those amounts is based off of. So the budgeted fixed overhead is based off of 25,000 budgeted hours. And the fixed overhead applied is based off of 26,000 hours allowed for the actual level of activity. So another way of determining whether it's favorable or unfavorable is whether or not the standard hours is more or less than budgeted hours. When the standard hours allowed is more than the budgeted hours, you will have a favorable variance, volume variance. But when the budgeted hours are more than the standard hours allowed, you will have an unfavorable variance. And this just gets back to the fact of how fixed overhead basically works. So when the standard hours allowed, remember that's based on the standard hours allowed for the actual activity, when that's higher than the budgeted hours, you're basically spreading that fixed overhead amongst more hours, right? So when it comes to fixed overhead, at least on a per unit basis, when we actually expand that discussion on how a fixed cost behaves, remember in total an actual fixed cost will remain the same, all other things held constant, but per unit, it varies inversely based on how activity changes. So the more units of activity you have, the smaller that fixed cost per unit. And when it comes to a fixed overhead, the higher the activity, the better, because that means we're able to spread that cost amongst more units of activity versus less units of activity. So this is it for the Appendix A, how we found the fixed overhead budget variance and the fixed overhead volume variance. So that's that for Chapter 10.